All right, everybody, we're live here, and we've got Brian from Frank and Brian, and we've got Sean, who's also friends with Jeff Fitzer, but Jeff couldn't join us today, so he's hands-on, and we're going to be talking about the situation that we've got going on with COVID-19 and all the possible forbearance situations that we've got in the United States. It can get pretty gnarly here, and that's why we've got Brian and Sean to talk about it, because they're more of the experts. Brian, thanks for being on, man. I always appreciate you.
Thank you, man.
And Sean, thanks, buddy. We're going to hear all of your expertise on this too. So Sean, take it over, buddy.
Yeah, so what David and I are, what David and I are going to talk about is the forbearance issue, that whenever the government came out and said that you can kick the can down the road on your mortgage payments and what that entails. So Brian, what I want to hear about is if people have taken that opportunity to skip 4 months, 6 months, what happens with how they're going to get pre-approved to purchase another house or to refinance, or actually what happens with the entire market, because it's kind of crazy what we're talking about here.
Yeah, it is. And we really have the potential to see this thing get more crazy as we're going down the road, and if we get a second wave here. What realtors and lenders need to understand, and their clients that they represent, is they need to understand CC&Rs. Those are covenants, conditions, and restrictions. And that is the nature between the mortgage market and the secondary market. So with the CARES Act, we can come out and say, well, you know, a forbearance is not a late payment. Or after 3 months payments, you can go ahead and get a mortgage again. The problem is that it's private money that is going to be lending that money. So the federal government could say whatever they choose to say through the CARES Act, but that doesn't necessarily mean that lenders have to follow those guidelines. For instance, according to FHA, you could get an FHA loan with a credit score of 520. Do you know any lenders who are lending on credit scores of 520? And the answer is no, they choose not to. So people really need to understand the covenants, conditions, and restrictions known as the CC&Rs. And there's going to be a lot of lenders who are going to look at these loans that are in forbearance, and even though they can lend on it, they're going to choose not to lend on it. So for a real estate agent right now, what you have to really consider, or what you really have to do, is message your past client, your current client database, and let them know that a forbearance has to be an action of absolute last resort. There is no free money that's going on right now. And I want you to consider this. So there are 4.58 million homeowners who have a forbearance right now. Now the numbers are down. So the assumption is like, hey, things are getting better. So it was at 8.6% of all mortgages, or excuse me, it was at 8.8% of all mortgages were in forbearance, which is a massive number. It's now 8.6. So it appears some people are coming out of forbearance right now. But I'm telling you, as I told you a moment ago, I just drove through the state of Washington, the state of Oregon, and I'm heading to the state of California, and I'm looking at all these restaurants and places where we could stop, and it's a ghost town.
Yeah.
So there is a real concern about a second wave. So consider this. Mortgage-backed security investors, they want their money, right? That's why they're going to invest in mortgage-backed securities, and that's why we have these just really unreasonably low interest rates right now, which is absolutely fantastic. But of the 8.6% of all mortgages that are in forbearance right now, that comes out to $995 billion, nearly $1 trillion in unpaid principal and interest. That can have a catastrophic effect on mortgages, which by extension is going to hurt our communities if we can't keep refinancing and having people purchase and sell homes. So we have to be concerned about forbearances. With a second wave of this COVID thing, everyone's talking about a V-shaped recovery. Now they're starting to talk about, have you seen it, a W-shaped recovery, which means we're coming back, we're going to go back down. That could have a huge impact on forbearances. And if we get that 8.6% and we bring it to 14 or 15%, the mortgage market is going to, the landscape of the mortgage market is going to look catastrophically different in the next couple of months. And we have to be concerned about that. And real estate agents really are the foot soldiers on the ground who are speaking with people. You've got 1.4 billion or 1.4 million real estate agents across the country right now. This is the time to be reaching out to your past client database, your current client database, your future client database, and letting them know the problems that it's not only going to create for them personally with a forbearance, but how it can have an impact on communities all across this country.
For sure. So whenever forbearance first came up, we had the news outlets saying, this is a great thing. You can skip this, you can push this back. And, you know, another thing is that if you're having an issue, there was no reason for you to have proof to go into forbearance. So what I want to talk about is, what are the main issues if somebody says, all right, I heard my news outlet, or I clicked on the website for my bank and they said skip 6 months worth of payments. Like, what are the bad things that could happen there that people just don't know about?
Well, so whenever we have natural disasters around the country, like fires in California, hurricanes down in Florida, tornadoes in the Midwest, that can create an issue that is isolated to a small geographic area. And so what we've historically done is we've allowed forbearances in those areas. But in every case outside of this one, homeowners had to prove hardship. In other words, if you're in Oklahoma and your neighbor's house is torn down and your house is still standing there, well, you can't go into a forbearance if your house wasn't destroyed. You had to prove hardship. But making it isolated meant it became a manageable situation. So what we've done differently this time is now it's national. Anybody in the country can claim a forbearance. And what we've done is we've taken away the hardship. And what that's allowed people to do is say, you know what? I don't want to make payments right now for the next 6 months. And we've made the path to that forbearance way too easy. And it's putting a massive strain on the secondary market, which is by extension going to have a massive effect on the primary market for mortgages. And we just have to be really concerned about how we deal with this. And again, as I said before, you know, with the CARES Act, you know, it's not a forbearance is not supposed to show up on your credit report, though it is. I will tell you this, though, you might not have your forbearance show up on your credit report and you think you're getting away with something, but it's certainly going to show up on your payoff.
Yeah, for sure.
And with our CC&Rs in place right now, if you are considering selling a house and you're in forbearance, you need to make absolutely sure, with double redundancy when you're speaking with your lender on that future purchase, that you're going to be able to acquire the money, or you're going to find yourself without a house. You could sell your house with the assumption that you're going to get a loan going forward, and then only to find out, even though the CARES Act says that you should be able to get a mortgage, that the private money which is behind this, mortgage-backed securities investors, simply aren't going to lend on that. So you have to be very, very concerned, and you have to work very, very closely with your lender to ensure, if you're selling a house, that you just don't find yourself stuck in a U-Haul truck for the next 6 months.
Yeah. So let's talk about that. Fannie and Freddie have the most lax rulings out there, to where if, say, I have a house, I have a conventional loan on it, I went into forbearance in March because I was affected, I lost my job, whatever, or I was furloughed. So I missed March and April's payments. Now I'm back. I'm making my mortgage whole. So I've made, the past couple months, and I found my dream home. I still need to get my house ready because I've been in it for 20 years. I've neglected it. I need to get it pretty, right? To get top dollar, but I can go ahead and purchase this other house. What's going to happen to me whenever I call my banker or my mortgage professional and say, all right, I need a pre-approval letter. I want to go right on this house this weekend because, market's so hot right now. Things are moving too fast. I need to get going. So what happens?
Well, I mean, right now, you should be okay. So what's going to happen if your loan has been in forbearance? You're going to obviously have to make that that mortgage whole for that mortgage-backed security investor, and you should be okay. Again, Fannie Mae and Freddie Mac, they give an implicit guarantee on a mortgage. They're not the ones funding the mortgage. They're guaranteeing that a payment is going to be made to the mortgage-backed security investor. So you might have a Chase, Citi, a Wells, a Flagstar, one of these companies who are going to actually be funding those loans. And again, they have different CC&Rs with those lenders out there. Most of them are non-banks. They have their CC&Rs and they can all vary. So you just have to be, you have to ensure that your loan is going to be ironclad going forward. I understand what the CARES Act is saying. I understand what Fannie and Freddie is saying, but the fact is they are not the ones who are funding these loans. You just have to be careful. But I will tell you the good news right now, over the past couple of months, the mortgage market has really started to find its footing again. We're getting our non-qualified mortgages back. We're seeing those coming in. Rates are actually starting to represent where the market is, which is cool. Volume is up. So these are all real positive things, but we have to look at the, on the horizon and find out what's coming at us. And, if we have like the W, not the V-shape recovery with this COVID thing, and we start shutting stuff down again, it could be a different landscape in a very short period of time. I cut my teeth in this market. I wrote loans in the 1990s. In 2008, I started doing a video blog called Think Big, Work Small at the time. And we covered the last, once in a lifetime meltdown, right? Well, now we're having our second once in a lifetime meltdown. The mortgage market had 15 months, somewhere right around there, to figure out the changes that needed to be made. And that's a relatively long period of time. And we did some stuff really good, and we did some stuff that was just kind of reactionary. We've got a few weeks in terms of the exact same outcome with this 2020 collapse. And so we just have to be really cautious in terms of how we navigate these turbulent waters, because as the mortgage market goes, so goes the housing market. And as I said before, we've got $1 trillion in unpaid debt. And one of the numbers that really kind of struck me, and I think we spoke about this before, but just to put this in perspective, in 2008, we were talking about billions of dollars in bailout. Now we're talking about trillions of dollars in bailout. Now, I want you guys to think about this. 1 million seconds is 11 and a half days. 1 billion seconds is 32 years.
A little bit of a difference.
1 trillion seconds is 32,000 years. So the numbers that we're looking at right now are massive. And I promise you, they're going to be paid, and there is going to be something of a reckoning. Now, it doesn't mean we don't necessarily, have the Fed who's going to buy mortgage-backed securities to the tunes of trillions of dollars right now, but this eventually or invariably is going to have to be paid back. So again, my big message to realtors is that you have to talk to your clients and let them know that a forbearance not only is going to hurt your ability to buy a house, with the CC&Rs that are in place, with those who actually fund the deals, rather than the implicit guarantee from the GSEs, the government-sponsored enterprises, Fannie Mae and Freddie Mac. But taking that forbearance could also hurt the market, which by extension can hurt our communities. And listen, there are people who absolutely need to. And in the case that you do, you should take that forbearance. But it should be, a measure of last resort.
For sure. So real estate professionals should be calling their past database. This is a great talking point, coming from contribution and having, being the professional and having the knowledge. But for people that are listing houses, the question should be also, you have a current mortgage on your house. What type of mortgage is it? And are you in forbearance? Because that could be a huge, I didn't know, whenever you're in a ratified contract and you're trying to perform, you're in escrow, and now this person can't. Let's talk about like FHA. They came out, and if I have an FHA mortgage and I went into forbearance because I needed it, what's my timeout period? I mean, I got to go sit in the corner for a while, don't I?
No, I think right now, if you're going to bring your mortgage current, I think most lenders today, if you're paying off your mortgage by selling your house, I think most mortgages with FHA or all the HUD deals, they're Ginnie Mae deals, which is going to be VA, FHA, and USDA. I think you're going to be okay. Like, I think everything is stabilized right now if you're going to bring your mortgage current. The only thing that we need to absolutely stress is that make sure your pre-approval, if you are in a situation where you're selling a house and you're buying a house going forward, you have to make sure that pre-approval with your lender is absolutely ironclad, because with the CC&Rs, different lenders are going to have different underwriting guidelines. So the Fed can come out, the Federal Reserve, the GSEs, Ginnie can come out and they can set the guidelines, but it doesn't necessarily mean that the lenders have to follow them. So we have these things called loan level price adjustments, and that's with Fannie Mae and Freddie Mac. So the lower your score is, the higher your rate's going to be, and that's kind of set in stone. There are absolutely no loan level price adjustments. Just hear me. There are no loan level price adjustments with any Ginnie loans, with VA, FHA, or USDA. Meaning, theoretically, your rates should be the same on every one of those, and your underwriting guidelines should be the same on every one of them, because HUD is not, or Ginnie Mae is not putting any loan level adjustments based on your credit score, your loan to value, any of that, anywhere. Yet we all know that lenders have different underwriting guidelines. They will write to different credit scores. They will write to different LTVs, and they will price their loans differently. Why is that taking place? It's because of the CC&Rs. So just understand as you're going forward, if you're selling a house right now, and yes, as a realtor, you have to be talking about forbearances. You absolutely, not only with those in your database, but if you're listing a house, you just don't want to find yourself where somebody who's sold that house and then you've got a mortgage going forward and that thing's not going to work. And right now the market is really great for this. So like, I don't want to sell fear. You know, this is not henny penny, the sky is falling. There are concerns on the horizon right now. The only thing I would suggest is if you want to truly fulfill your fiduciary to your clients, you have an obligation to ensure that whatever lender that you're working with is going to fund that loan if that person had a forbearance plan, period. Because every lender is going to be different based on the nature of the relationship that they have with the secondary market.
Wow. Yeah, and let's hope, or let's say like a second wave doesn't come through and all these businesses shut down or these states shut down and things of that nature, which we already see the opposite of happening.
Right.
How does forbearance go away? Because it's law, correct? And like, we just can't turn it off and say, okay, no more forbearance, we're done with this and let's shelve it. What happens, or how do we get that? Does it have to be amended through government, I'm assuming?
Yeah, well, we certainly can turn it off. We can amend it, we can change it, we can turn it off. But what are the unintended consequences of that going to be? And it's going to amount to a surge in foreclosures across the country. One of the interesting points, well, I don't know if it's kind of interesting to me, but 30% of all those making a payment, either mortgage or a rent, are currently behind. 30%. That's a massive number because people are or even underemployed. And what we have to ask ourselves is, what is our behavior going to be like as we go forward if we're coming out of this thing and we don't have a second wave? Again, I just drove 800 miles through 200 cities with a bunch of my nieces and nephews and kids and their friends. And I'm going to some of these places that I've been going to for 25 years. I literally, right across the street from me is a place called the Black Sheep. If you want to have shepherd's pie, I'm telling you, it's the best in the country. But what they're doing is they are seating 25%. How many small businesses can keep their doors open on 25%? Not many. How many people are going to go back to movie theaters? How many people are going to jump on planes again? So these are all questions that we simply don't know the answer to. But there's a lot of businesses that they're not sustainable based on the amount of business they're going to get in our current environment. Not only in this pandemic, but even coming out of the pandemic, what's going to happen then? And how is that going to have a trickle-down effect on the mortgage market? 30% of the people right now who are making a mortgage or rent payment are behind or not making it at all. That's going to have an effect on the number of forbearances. So even though they're down from 8.8% to 8.6% right now, and again, things are okay right now, but there is a concern with what we see on the horizon. And for a realtor or a lender, well, especially our realtors, the realtors are really kind of the frontline defense because they're the ones who are kind of talking with their clients. They're the ones who are listing homes. Your conversation needs to begin and end talking about forbearances, period, to ensure that you're fulfilling your fiduciary to your client, but also to ensure that you're protecting your community. Again, with the number of realtors we have across this country, it's a volume game. Like, everybody's got their personal ecosystem, their sphere of influence. And if every realtor in the country were to reach out to their database and those who they're listing homes of, they could have a massive, massive effect, and they can truly help our communities and help what's going on. Because remember, it's a very shocking number. 8.6% of loans are in forbearances right now, and that comes out to $995 billion in unpaid principal. That money is being picked up by our servicers. It's being picked up by liquidity facilities that are put forth by the Treasury. The Federal Reserve is picking it up for the GSEs, but we simply cannot afford to keep, adding zeros on spreadsheets because it's going to have a long-term effect. And I'm telling you, this money is going to eventually have to be paid back. Forbearances need to be a measure of last resort.
I would really like to know, and this is such a hard number to come up with, as far as like who actually needed the forbearance option, because in my office, we actually had some clients that we were trying to refinance that went into forbearance because they wanted to skip 4 months worth of payments, so they put sod in the yard.
Right.
People just don't understand the ramifications of their actions. They're like, ooh, I get to save X amount of dollars over the next 4 to 6 months, and I can allocate these funds somewhere else. But they really don't understand how it's like, the trickle effect, where you drop the pebble in the pond and all these different waves start going out. How bad that really is, just to save 4 months worth of payments or 6 months worth of payments. So
I can tell you, so of all four loans that are in forbearance right now, 58% of them are self-employed people.
Okay.
It's a huge number. So, and that kind of makes sense, because if you're self-employed and, you're working at a, 25 to 50% capacity, when you're used to working at a 95% capacity, you're going to have a higher number there. The state that has the highest number of forbearances is New York, which is at 68%. Wow. Think of that. California has the lowest ratio at 29%. So we do kind of understand what the demographic is going to be, but this is just a big, big number that needs to be taken into consideration. Again, if you need a forbearance, certainly go ahead and take it. If you need it, if you truly have hardship where you're not going to be able to make the payment on that house, or even in that investment property, because you don't have the money for it and you have to put food on the table, take it. But just like you said, do not use a forbearance to go to Home Depot so you can put a new roof on, or you can redecorate your car, or get your house, or get new carpet or something like that. It has to be seen as a decision of absolute last resort. And the issue that we have right now is we've made forbearance too easy. All you have to do is say hardship. You don't have to prove hardship. You can just say, I'm being affected by the coronavirus. So is there going to be a portion of our population that simply is going to say, I don't want to make my payment, I want to go on vacation, I want to redecorate my house? There certainly is. But the unintended consequence of that is $1 trillion in unpaid principal and interest right now, which is being picked up by the feds at the Treasury level. And that money is going to eventually have to be paid back, and we will find it in higher rates and harder guidelines.
Yeah, and the barrier to entry, just throwing gasoline on the fire with these folks taking this, because if you go to your online website where you make your payments or whatnot, there's a bulletin at the top. Are you affected by COVID-19? Yep. Yes or no? Yep. Yes. Okay. Do you want to go into forbearance? Yes. There's no, hey, I need an employer letter, or I need something showing that you lost your job or you lost 50% of your income. Because I have friends that had to give up 50% of their salary to stay employed, which, if things run tight, then that might be an option for them. But just to go to a website and click yes, and now I can go buy the plasma or my big screen TV that I wanted, or whatever. It baffles me, and I know that they rush this thing through to try and help out as many people as possible. But sometimes whenever you're rushing, some of those details unfortunately get missed. And barrier to entry, I mean, that's a big one for me. We've made it
way too easy. Another thing to consider is, for those who are looking at a forbearance, they should be looking at a refinance. So the mortgage market, our busiest year was $2 trillion. We're going to run $2.7 trillion through the mortgage market this year. It's going to be the busiest year on the books ever. And our lenders are going to be taxed. It's going to take more time to get these mortgages. But as a homeowner, what you should be looking at is a refinance rather than a forbearance. Because right now, as it stands, 13.4 million homeowners are eligible for a refinance, and things have loosened up. Mm-hmm. So if you want to do those home improvements, you should be speaking with your lender, because right now rates are lower than they've ever been. I mean, they truly are. We're always hitting superlatives over the past couple of weeks. And right now you could, probably do a cash out refinance on your house, a debt consolidation, a home improvement loan, lower your rate, and possibly even lower your term. That's going to be a better bet for you than doing a forbearance.
Yeah, I don't know. Hopefully sometime in the near future, everything gets back to what we like to call normal. But I don't know when that's going to be.
Well, like I said, in 2008, I remember at the end of 2008, I said to myself as a lender, my God, if we could just get through this year, everything's going to be okay.
Yes.
And of course, it took 4 years.
Yeah.
And that was the once in the lifetime catastrophic meltdown of the mortgage market. Mm-hmm. We find ourselves 13 years later in another once in a lifetime catastrophic meltdown. Again, that one was spread out. This one is shorter, and this one's way more complicated because we knew what the causes of the last meltdown were. This one is out of our control. No, I don't know. You don't know what's going to happen with this whole COVID thing. I hope we don't have the W. I hope it's just a V. But does anybody really know that? And then what are people's behavior going to be like as we come out of this thing? Like, how are people going to behave differently, and how is that going to affect commerce? Like, for instance, I think everybody understands that everyone's moving to a digital platform in every component of every market in the country. But that was going to take years to do. But with this COVID thing, it's speeding up the entire process, isn't it? Like, how many people would have maybe gone online to buy things, but it would have taken them a couple of years, like my mom, to do? Well, now she's afraid to go outside and go to her supermarket, so it's speeding up the process, and she's buying more stuff online. This is my mom, who's 75 years old. So what this is doing is speeding up the process, and when people are buying things online rather than going down to their local grocery store and that type of stuff, we're taking money out of communities and we're centralizing it in different areas around the country, right? So what is that going to do to, Topeka, Kansas? What's it going to do to, Vacaville, California? What is it going to do to Ashland, Oregon when people's behavior changes? And we all kind of knew that this was coming, but it's really speeding up the whole process. It's going to be, I was just having a conversation with the smartest 19-year-old kid on the face of the planet yesterday. And, he had some really interesting insights on this stuff. And I'll tell you what, it's going to be their generation that's going to have to deal with this. But we will find out what would have taken 10 years. We will find that in the next 6 months.
Yeah, and I guess the only positive out of all of this is that during crisis in our industry, we still try and find a way. And we pick up efficiencies. You're talking about digital, trying to get money should hopefully be a little bit easier instead of the old, let's sit down for 2 hours and talk about everything. That's my silver lining, that we're going to get better at what we do. You're going to, some real estate agents would love to hear that you're probably going to see an exodus out of that space to where they can pick up more market shares. But, who knows? Because with inventory woes, with trying to find qualified people to purchase the house and then being in a bidding war like a piranha feeding fest. I do believe that you will see the players stay in this business, and that the efficiencies of operating this business will get a lot more streamlined and a lot more efficient for sure.
Well, we have one of the hottest real estate markets in my lifetime, the past 25 years. Mm-hmm. And here's what people are doing. And I think we spoke about this before, but people are looking at their houses now as their safe havens, aren't they? Yeah. People are not doing the 2-hour commute to work and coming back. I know people who commute from Sacramento to San Francisco. That drive is going to take you anywhere from an hour to 5 hours. Mm-hmm. Now, imagine the mindset of a person who's coming home at the end of the day. They're looking at their house and their mortgage as a ball and chain. Well, a lot of people are working from home now, and a lot of people have been spending time working on their safe haven. Like, they're looking at their house as their safe haven, and they're starting to reconsider, like, hey, maybe I need a different house. We are looking inward now more than we used to. And in 2008, the mortgage and real estate market was seen as the cause and problem of the global meltdown. We are now seen as the solution to the meltdown, and we truly are.
We're going to be good guys this time, is what you're saying?
We are the good guys.
The good guys are not vilified?
Yes. We take off the black hat and we got the white hat on now. But yeah, no, we are seen as a solution, and we truly are, because whenever somebody buys and sells a house, we are putting money back into our communities, aren't we? That absolutely takes place. And as people are, kind of sheltering and looking at their house as a safe haven, they're looking at it differently today than they did just a couple of years ago. So this is a great thing for realtors to really consider right now. This is a great time to reach out to your past client database. I think last time we spoke, I told you there was a study done by NAR that said 75% of the people, and this was like a year and a half ago, thought it was a good time to sell their house, yet they weren't necessarily listing their house. We have more people right now who are sitting on the fence, but they just don't believe it to be a good time, because when you look at the 24-hour news cycle, they're telling you everything is falling apart. When in truth, every property in every major metropolitan area has gone up over the past 6 months. I would have never, ever guessed that. Like, when I was looking at this whole COVID thing, I'm like, oh my God, this is going to trash the real estate market. I was convinced of it. I mean, Think about this. We took 90% of the people in this country, and we told them, you can't go to work. And yet the real estate market still went up. It is remarkable right now. In fact, it is a great time to list your house. And people are looking at their homes. And I believe that because people are sitting in their homes more often than sitting in a car commuting for 4 hours a day, this is a great time to reach out to people and dispel all the myths about what's going on in real estate. 1, don't get a forbearance. 2, you should really consider listing your house and buying another one. This is the right time with rates as low as they are. And go figure, your property has actually gone up in value, not down in value. And I can prove it to you with comps and a BPO.
Right.
I'm telling realtors right now should be making more money than they ever have. They should be reaching out to folks. They should be trying to shove another $700 billion down the mortgage market with buying and selling homes. It will not only help their pocketbook, but it will, in fact, help their community. We need to mobilize real estate agents, and they need to look at themselves not necessarily as a salesperson, but a community advocate. Do this not only for your own personal benefit, but do it because when you list houses and sell houses and keep people out of forbearance, you protect your community. Now, this might seem hyperbolic, but I'm telling you, in fact, it's not. Because we have a crossroads coming, people, and it's going to go this way or this way. And the real estate community can ensure that we are going to go in the right direction.
Yeah. And I would think that with people being pent up, and especially going through a second wave of it, the folks that are in condos or high rises, and you might see people trying to get out and get a little more space because, one, they don't want to be around people, but they also just want some extra space in their living quarters as well.
Well, in fact, that was already taking place. So if you look at I think the most highly condensed area in the country, which is going to be Manhattan and New York, they've been losing population for the past 3 years. People are moving out to the suburbs. Now, again, the coronavirus is going to speed everything up, how we communicate, but it's also going to change how people live, because you're absolutely right. Yeah. Like, do you want to be in a high rise where everyone's pushing the same button on the elevator?
Nope.
I'm sitting in a hotel right now, and I'm looking around saying, I don't know if this is the greatest thing in the world for me to be here. But I had to go see my in-laws, and we have the greatest 4th of July in Southern Washington. I'm not kidding you. You can buy any firework you want, like things that are just remarkable that they'll sell them to you. You can get mortars that have 120 grams that are this big and blow them up. It's wonderful. But, as I'm, doing this drive, it's it's going to be about a 1,000-mile drive by the time it's all said and done. I'm absolutely looking around, and I'm second guessing what I'm doing. So yes, people want to start to sprawl and really kind of think about their home as a safe haven. Is your house truly a safe haven where you're not going to catch this darn thing if you're all hitting the same buttons on the same elevator? So, as a real estate agent, another really great thing that you should do is, if you're in the suburbs of any major metro area, you should find a way to have a relationship with the realtors who are working in these densely populated areas. Like, I tell that to realtors where we live out, I'm in between Sacramento and San Francisco, but I tell all my realtors, you need to find San Francisco-based realtors, because they're going to find a lot of people who are moving out. 1, because it's cheaper, and 2, this is the one that is fundamentally different, is people are starting to see it as safer.
Yeah.
Where you don't have to live on top of each other. So yes, there is a massive migration that's taking place across this country, and we're seeing it in the number of deals that are being done right now. It is going to be the best year on the books in real estate and lending that I've seen in my lifetime, and it kind of makes sense. Provided, again, the caveat being that we don't see things changing drastically in terms of the number of loans that are going into forbearance, and really kind of putting a stick in the spokes and sending the mortgage market over the top, over the handlebars of the bike. You know what I mean?
So just recapping, call your PAX folks, talk to them about forbearance and the issues that could arise if they take it. And then whenever somebody is listing a house, understanding if they have a mortgage, if it's in forbearance, and what could be the issues whenever they go to make that house live, especially if they're going to be purchasing a house prior to them selling their current one. So
right.
If they sell their house and then purchase a house, a domino effect, you should be fine. But if you're holding on to that residence now and your mortgage is in forbearance and you're trying to buy the other house, that's where the main issues are going
right.
to to happen. Okay, perfect.
Right.
Brian?
And understand that, make sure that you have an ironclad approval with your lender, because the CC&Rs that they have in place on the money that they're lending could be different from one lender to the next. So just, again, the market seems to have stabilized over the past couple of months. It could certainly change here in the next couple of months. Just do your due diligence, fulfill your fiduciary, make sure that lender that you're working with has that money pretty much wrapped up.
So basically, the dumbify it, Fannie, Freddie, and Jenny, the agencies that make the rules, can say whatever they want. The banks that are lending the money don't have to follow those rules. So it's like, we don't want to do that. Okay.
Oh, and by the way, none of them follow it. Understand that. Like I said, according to Jenny, you can get an FHA loan with a 520 credit score. I don't know a single lender in the country who would do that deal. And when you find a lender who will do one to like a 580 credit score, there's going to be a cost assigned to that. Jenny is not assigning that cost. So yes, every lender with their CC&Rs that they have in place right now, you can have your implicit guarantee from Fannie and Freddie. Jenny has no loan level price adjustments, but all the lenders are going to be looking at what they're funding differently. And I'll tell you right now, a lot of them are risk adverse. Okay. They don't want to deal with a loan that's in forbearance. So when a loan goes into forbearance, the CARES Act on a federal level can say, well, that's still a current loan. But the CC&Rs that they have in place with whoever they have that warehouse line with can say, that's just a defaulted loan. So there's a real big concern about this type of stuff. And again, the market has seemed to stabilize because we put liquidity facilities in place to ensure that the mortgage-backed securities investors are going to be made whole. So servicing and secondary seems to be okay right now.
Yeah.
But if we see the W and a spike, and we see that we go from 8.6% of all mortgages that are in forbearance, if that goes up to 14 or 15%, it's a whole new ballgame, a whole new ballgame. Yeah. So again, to reiterate, to be redundantly redundant, realtors, reach out to your clients, your past client, your current, your future clients, have the conversations about forbearance. Let them know it is an absolute last resort. Look at a refinance first, and then ask them if they want to list their home, because a lot of people think that their values have actually gone down when they in truth have gone up. There's a real big misconception there. So there's a lot of meat on the bone for realtors here to help their communities and also get more listings. And the last time I talked to a real estate agent, getting a new listing is like getting a Willy Wonka golden ticket. It's what everybody wants.
For sure.
Is there a single realtor in the country who does not want to be a listing agent?
Everybody
wants to be a listing agent. You could actually be it in this market, but what you have to do is we have to get the wheels turning. You got to get on the gerbil wheel and start running right now.
So work. Okay, perfect. All right, Brian. Well, I appreciate your time.
Well, thank you. And for those of you, if you ever have a chance to come through Oregon, make sure you stop in Ashland. It's absolutely beautiful. Go to the Black Sheep, get their shepherd's pie, and if you come in here on a Sunday, there's a bunch of old Irish guys playing old Irish tunes in there, and it's all free of charge and absolutely wonderful.
That's awesome. Awesome. Well, yeah, next time I'm in Oregon, the first time I'm in Oregon, I will definitely get you. All right, sir. Thank you very much. Have a great day.
Thank you. And you guys, happy selling.
Yeah, bye-bye.